Brent and WTI can blow out, gas becomes cheap in the U.S., but it's worth a lot if you can supply it to Asian markets. So having a diverse but not diffuse portfolio, I think, is important. But as we think about capital allocation, you need a little bit of all that in your portfolio, because even though they might be lower return investment opportunities in oil sands or big LNG projects, they also last for 40, 50 years. And they have very little decline because they're backed up by a tremendous amount of resource. So having some of that in your portfolio is important as you try to manage across all the competing metrics in this business.
And as you do that assessment, you look at both the above ground and the below ground risk.
And I think that's really important. So as you're going globally, we start and want to assess the subsurface. We want to understand what the risks associated with development are, but we have to marry that with the surface risk, the fiscal system, the rule of law, the security situation. All those kinds of things come into our calculus as we try to make those decisions as where to spend the capital.
So one of the questions the Washington community frequently asks is how resilient at a $40 or $50 price is the U.S. industry? And we had spoken earlier about investment decisions and dollars spent in 2012, 13, and 14 kind of set the stage for where you are 2015, 2016. Can you talk about that lag a bit?
Yeah, so we talked a little bit. People are saying, well, what will be the rate of growth and the increase in the U.S. production in 2015 as a result of having $40 or $50 prices that we're seeing today? And the reality is the rate of growth or the amount of production probably is not going to be heavily influenced by the price today, because we made investments the last 2 to 3 years that are now coming into production in the unconventionals in North America in 2015 and 2016. What will happen if lower prices persist is we're a very capital-intensive business. So of all the revenue, and you see the numbers that come out of the revenue, we get a lot of press for that, but the important thing is we reinvest up to 80 and 90% of the money that we make back into the business in capital. So we make a lot of investments. And so as our cash flow comes down, as commodity prices come down, we have less to invest back into the business, and that will impact ultimately the rate of growth in production from the unconventionals. But the important thing, and I tried to allude to this in my speech, is we do believe the cost of supply in the unconventionals is very competitive to whatever investments, most of the investments companies have around the world. So even in they're resilient down to $60 and $70 a barrel, cash break-evens are even much lower than that. So these are investments that will continue, but certainly as companies have less amount of cash to reinvest in the business, it will impact the amount of capital that we're going into and the absolute amount of growth we can see over the next couple of years.
Excellent. So I have to make a plug for our program here. The last 2 years we've been looking at an infrastructure project with the belief that even as the E&P side, the production side, moves up the supply curve, unless